I think what you need to separate is looking in the rearview mirror and the old data and expectations moving forward. So if you unpack quarters, what you're really seeing is that there was weakness. There was weakness in January and there was February, and March started to turn around. And you're seeing that throughout the multinational complex. And we saw that with the financials. We saw it with the industrials. And I suspect we're going to see it with tech this week. And that's painting a picture of just linearity getting a lot better. So I feel pretty comfortable with this moving forward.
Sure.
The data is pretty weak. Europe in particular still looks mired in its malaise.
Yeah.
However, the market's up 17% this year over there. And what that's telling you is that we have bottomed. Our expectations have bottomed. Even last week we had those terrible PMIs. And the markets were up over there.
And they were terrible. So, Bob, let me ask you about this as well then. Are the earnings helping the market get to new highs simply because it was better than feared? Or do they tell us something about a sustainable strength in the U.S. and even possibly the international economy?
I think what we're seeing here is flattish earnings growth in the first quarter and likely also somewhat flattish in the second quarter, but no earnings recession. That's number one. Number two, the big debate is where do you come down on the recession debate? If you think there's going to be a recession in 2020, earnings are going to drop 10 to 20%, and so is the market. But right now, the evidence supports the idea that there isn't going to be a recession in 2020. I agree on China. Bottomed in the January or February. We have Shanghai up 30% this year, and the stock 600, as she mentioned, up about 17% this year. Europe is still pretty iffy.